Market structure is probably the most important concept in trading, and it's also the one that most people skip. They jump straight into strategies, indicators, entry signals, all the exciting stuff, and then they wonder why nothing works consistently. Here's the thing. Every strategy you've ever learned, whether it's supply and demand, smart money, ICT, whatever, all of them assume that you can already read the market, that you know what the market is doing right now, where it's likely going next, and when it's too dangerous to trade at all. That's market structure. It's the foundation. And if your foundation is weak, everything you build on top of it will collapse. So in this video, I'm going to teach you market structure the way I wish someone had taught me. Not just the textbook definitions, but the actual mechanics of how and why the market moves. By the end, you'll have a simple framework you can apply every single time you open a chart. Let's start with something you look at every single day, but probably never think about deeply enough. A candlestick. Most people see a green candle and think bullish. They see a red candle and think bearish. But that's like reading a war report and only looking at the color of the ink. Every candlestick on your chart is a battlefield report. It records who attacked, who defended, and who ran out of ammunition, all within that specific time period. Let me show you what I mean. A long green body. Now that's not just bullish. That means the bulls dominated from the opening bell to the close. They pushed price up with virtually no resistance. The bears didn't even show up. A long red body, the opposite. The bears crushed everything in their path and forced price down without mercy. Now here's where it gets interesting. A long upper wick. That means the bulls tried to push price up. They attacked, but they got smacked back down. That's a failed attack. The bears absorbed the pressure and pushed them right back to where they started. A long lower wick. The bears tried to drive price down, but their selling got absorbed. Someone ate all their sell orders. That's the opposite side stepping in and saying, "No, we're buying everything you throw at us." And a doji, a tiny body with wicks on both sides. That's a stalemate. Neither bulls nor bears could gain control. They fought to a draw. So here's the mindset shift. When you look at a chart, stop seeing green and red. Start seeing who's attacking, who's defending, and most importantly, who's running out of energy, because that's what tells you what's about to happen next. Now, how does each side actually fight? The bull strategy is simple. Push up and defend. They use aggressive market buy orders to push price higher. And then they defend at every structural low, every higher low. Clusters of orders pile up. Limit buys, reactive market buys, algorithms, all sitting there waiting. Every time price pulls back to these levels, that concentrated demand catches the fall and bounces it back up. The result, higher lows. The defensive walls keep moving up. That's an uptrend. The bear strategy is the mirror image. Attack and suffocate. They use aggressive market sells to break through bull defenses. And then they suffocate at every structural high, every lower high. Clusters of sell orders pile up. Limit sells, reactive shorts, algorithms. Every recovery attempt gets smothered at these ceilings. The result, lower highs. The ceiling keeps dropping. That's a downtrend. But here's the critical piece that most people miss. Price tells you who's winning, but volume tells you if they're actually strong. This is Wyckoff's principle of effort versus result, and it's one of the most powerful tools you'll ever learn. When you see high volume with a long candle body, that's real money pushing the market. Trust it. When you see high volume but a short candle body, that's a warning sign. Someone is putting in massive effort, but the price isn't moving. That means the opposite side is absorbing all those orders. They're eating everything thrown at them. And when absorption happens, a reversal is often close. When you see low volume with a long candle body, be very careful. The price is sliding through empty space. There's no real conviction behind that move. It's a trap, and it's not sustainable. And when you see low volume with a short body, both sides are exhausted. Nothing is happening, just wait. One quick note on volume. This works most reliably on exchanges with real volume data. Futures, stocks, major crypto pairs. If you're trading spot forex, the volume on your platform is tick volume, not actual traded volume. It's still useful as a rough guide, but don't treat it as gospel. Now, you don't need to act on any of this yet. Think of these volume readings as clues, individual clues. On their own, they don't tell you what to do. But when you combine them with the concepts coming next, market states, BOS, CHoCH, that's when the clues start forming a complete picture. Remember this, when effort doesn't produce results, someone is being betrayed, and that's exactly when the structure of the market is about to change. Now you can read individual candles, but the real power comes when you zoom out and see the bigger picture, the four states that every market constantly cycles through. Before you ever think about placing a trade, before entries, before stop losses, before anything, there's only one question you need to answer. What state is the market in? There are four, and if you get this wrong, nothing else matters. State number 1, uptrend, bulls in control. Here's how it works mechanically. The bulls attack, they push price up and break the previous high, creating a new higher high. Then the bears try to counterattack, but the bulls defend their position. Price bounces off their defensive line and creates a higher low. This cycle repeats higher high, higher low, higher high, higher low. The bulls keep expanding their territory, and if you watch volume, you'll see it clearly. Volume is high on the impulse waves when the bulls are pushing up, and volume is low on the pullbacks when the bears are trying to fight back. That tells you the bears are losing steam. There's one line that matters more than anything else in an uptrend. It's the higher low. The HL is the bull's lifeline. As long as they defend that line, they're still in control. Lose the HL, and they lose the war. Your rule in an uptrend is simple. Only look for buys. Trade with the army that's winning. State number 2, downtrend, bears in control. It's the mirror. Bears attack, break the previous low, creating a new lower low. Bulls try to recover, but the bears push them back down, creating a lower high. Volume is high on the sell waves. The bears are in charge. Volume is low on recovery attempts. The bulls are running out of ammunition. The key line here is the lower high. LH is the ceiling. As long as the bears maintain that ceiling, they're in control. Your rule, only look for sells. Now, state number 3, ranging. I call this the ceasefire. Most traders look at a ranging market and think, boring, nothing happening. But that's one of the most dangerous assumptions you can make. Because ranging doesn't mean the market is dead. It often means smart money is quietly doing their work. In a ranging market, price bounces rhythmically between two clear boundaries, support and resistance. And if you look at volume, you'll see something interesting. Volume spikes at the boundaries. Real money is active there. Here's the deeper layer. If you see heavy volume at support and price bounces strongly afterward, that's accumulation. Someone is buying everything. If you see heavy volume at resistance and price gets rejected hard, that's distribution. Someone is selling into every push. The key is what happens after the volume spike. Does price react, or does it just keep hovering? If it hovers, be cautious. That could be slow selling disguised as support. The market looks calm on the surface, but underneath, the next big move is being loaded. Your rule in a range, the higher time frame trend, tells you which boundary to trade. If the bigger picture is bullish, buy at support. If it's bearish, sell at resistance. If you're not sure, just wait for the breakout with volume confirmation. Now, state number 4, choppy. This is no man's land, stay out. Choppy markets look like chaos. Overlapping candles, consecutive dojis, long wicks in both directions. Every breakout reverses within 1 or 2 candles. Fake outs everywhere. Volume is either dried up or completely random. In choppy conditions, neither bulls nor bears are committed. You're not fighting an army, you're fighting shadows. Your probability of being right is no better than a coin flip. And here's how you tell ranging apart from choppy. Because this is critical. In a range, the boundaries are clear. They've been tested multiple times. Candles make clean swings between them, and volume follows patterns at the boundaries. In choppy conditions, boundaries are blurry. They get broken and rebroken constantly. Candles overlap with no direction, and volume is random. Range, you can work with it. Choppy, get out. That's the #1 rule. And if you're not sure whether it's ranging or choppy, treat it as choppy. When in doubt, stay out. The market will always give you another opportunity. Your capital won't. Okay, so now you can read candles, and you can identify which of the 4 states the market is in. But here's where most traders get absolutely destroyed. They can't tell when the state is changing, and that's what BOS and CHoCH are really about. You know the 4 states now. The critical question, How do you know when the state is changing? This is where 90% of traders make fatal mistakes. So slow down, this section is the most important part of this entire video. Let's start with BOS, break of structure. BOS simply means the side in control continues to expand their territory. In an uptrend, BOS happens when price closes above the previous swing high, not the all-time high, the most recent swing high. Each time the candle body closes beyond the last swing point, that's a new BOS confirming the trend is alive. In a downtrend, BOS happens when price closes below the previous swing low. Now you might be wondering, which swing high, which swing low? There are so many on the chart. I'll show you exactly how to identify the right ones in a moment. For now, just understand the concept. But here's the key. There are two conditions for a valid BOS. First, the candle body must close beyond the level, not just a wick poking through. A wick that pokes through and pulls back is not a BOS. That's a trap. Only when the body closes on the other side is the territory actually confirmed. Second, volume should increase on the breakout candle. That tells you real money is participating, not just noise. BOS means the trend continues. Your action, look for entries with the trend on the next pullback. Now CHoCH, change of character. This is where power shifts from one side to the other. Here's what it actually means. The controlling side just lost their most critical defense line. In a bearish CHoCH, when an uptrend is dying, three things happen in sequence. First, the bulls fail to push price to a new higher high. Their attacking power is exhausted. Second, the bears counterattack and close below the most recent higher low with increased volume. Third, the bull's lifeline is broken. That's a power transfer. Bullish CHoCH is the mirror. Bears fail to make a new lower low. Then bulls break above the most recent lower high with volume. The bear's ceiling is shattered. Now there's also a more aggressive form of CHoCH that catches a lot of traders off guard. Sometimes price does make a new higher high, and you think the trend is continuing, but then it immediately gets slammed back down and breaks the previous higher low. What happened? That new high was actually a liquidity grab. Smart money used the breakout to sell into all the FOMO buying, and then crashed it. So don't assume that a new high means you're safe. Watch what happens right after. If the structure breaks on the way down, that's an even more dangerous CHoCH because it trapped everyone first. And this is critical. A valid CHoCH needs volume confirmation on the break. If the break happens on low volume, it might just be a liquidity sweep, not a real power shift. More on that in a minute. And here's something that will save you a lot of money. CHoCH does not mean you immediately trade the reversal. Let me say that again. CHoCH does not mean enter a trade in the opposite direction. What it means is stop trading the old direction. That's it. Wait for the new structure to confirm. The transition zone right after CHoCH is the most dangerous place on any chart. Here's what actually happens after CHoCH. The market almost never jumps straight into a new trend. There's usually a ranging or consolidation period. This is where smart money builds their position for the new direction. The new trend is confirmed only when you see the first BOS in the new direction. So remember, CHoCH equals stop old trades first. BOS after CHoCH equals green light for the new direction. Now the number one mistake traders make with CHoCH. They confuse noise with a real change of character. Inside every impulse move, there are smaller highs and lows. Price breaking a minor internal high or low. That's noise, that's not a reversal. So how do you tell the difference between a major swing point and a minor one? Here's the practical test. A major swing point is one that's clearly visible when you zoom out or switch to a higher time frame. If you have to squint to see it, it's internal noise. Major swing points are the ones that created the most recent BOS. Here's the golden rule. Valid CHoCH only occurs when price breaks the major swing point, the one that directly created the most recent BOS. Let me give you a concrete example. Say the market makes higher high 1, then higher low 1, then higher high 2, then higher low 2. If price breaks a minor low inside the push-up to higher high 2, that's noise, internal structure, ignore it. But if price breaks higher low 2, the one that created higher high 2, that's a real CHoCH. Jumping into a reversal trade on a minor break is not trading smart. It's turning yourself into liquidity for smart money. Now everything I just taught you about BOS and CHoCH has one critical condition that overrides everything, and most traders completely ignore it. Always check the higher time frame first. A CHoCH on the 5-minute chart means absolutely nothing if the 1-hour chart shows a strong uptrend. A CHoCH on the 1-hour chart is significant, but you need to check the 4-hour or daily chart first. The higher time frame always wins. Think of it this way. The daily chart is the general strategy. The 1-hour chart is the battlefield commander's plan, and the 15-minute chart is the individual soldier's view. A soldier can win a skirmish, but the general strategy determines the war. Here's your practical rule. Use at minimum 2 time frames. Read structure on the higher one first, then zoom into the lower one for precision. And never ever trade a lower time frame signal that contradicts the higher time frame structure. Now you understand BOS and CHoCH, but there's one more layer that separates amateurs from professionals. Understanding why your stop loss keeps getting hit right before the move happens. Have you ever noticed that the market seems to hunt your stop loss? Like it specifically targets your level, takes you out, and then moves exactly in your direction. That's not bad luck, that's by design. Here's why. Imagine a hedge fund that wants to buy $100 million worth of an asset. They can't just hit the buy button. If they did, price would rocket up before they finished filling their order. They'd destroy their own entry. To buy at a good price, they need sellers, a lot of sellers. But who would sell in an uptrend? Nobody wants to sell when price is going up. So what happens? Whether by deliberate design or simply by the mechanics of how large orders interact with the market, is that price gets pushed below key support levels. Sometimes institutions actively drive it down. Sometimes they simply withdraw their buy orders and let gravity do the work. Either way, the result is the same. Price drops below support just far enough to trigger thousands of stop losses. And here's the key insight. Every buy stop loss is a sell order. Those thousands of triggered stop losses create a massive wave of selling. And that selling is exactly the liquidity that large players need to fill their buy positions at discount prices. Now look at your chart differently. The market is like a map with pools of liquidity sitting at predictable locations. Above old highs, especially equal highs that have been tested multiple times, there's a pool of buy-side liquidity. That's where buy-stop orders from short sellers sit, plus breakout buy orders from traders waiting for confirmation. Below old lows, especially equal lows, there's a pool of sell-side liquidity. That's where sell-stop orders from long positions sit, plus breakout short orders. Smart money doesn't trade breakouts. They exploit breakout traders. This is exactly how bull traps and bear traps work. A bull trap at resistance. Price breaks above resistance. FOMO traders pile in and buy. Smart money sells into that buying pressure. They use the retail buying as liquidity to fill their sells. Then price reverses. Now the stop losses from all those FOMO buyers get triggered, which creates even more selling. It becomes an avalanche, a bear trap at support. Price breaks below support. Panic selling kicks in. Shorts pile on. Smart money buys from all of that selling, absorbing every sell order at discount prices. Then price reverses hard. Short squeeze rocket. So how do you protect yourself? You need to distinguish a sweep from a real BOS. A sweep or a trap looks like this. A long wick pokes through the level, but the candle body closes back inside the structure. Volume spikes on that candle, but then drops immediately, and the very next candle reverses direction. That's not a breakout. That's smart money collecting liquidity. A real BOS looks different. The candle body closes outside the structure. Volume shows a sustained increase across multiple candles, and the next few candles continue in the breakout direction. Here's the rule that will save your account. Always wait for the candle to close. Never enter a trade while a candle is still forming. Wick through equals trap. Body close through equals confirmation. The reality is that a significant majority of breakouts fail, which is why entering at a zone without waiting for candle close confirmation is one of the highest risk mistakes you can make. Let's take a step back. This video didn't teach you when to enter trades. It didn't give you a strategy or a setup. It taught you something far more important: how to read the market. And that is the most fundamental. Here's the framework you can apply every single time you open a chart. Step 1. Check the higher time frame. What does the daily or the 4-hour chart say? That sets the direction. The general strategy comes first. Step 2. Identify the state on your trading time frame. Is it trending, ranging, or choppy? If it's choppy, close the chart and walk away. Step 3. Determine who's in control. Are you seeing BOS confirming the current trend? Or has a CHoCH happened? Is power shifting? Step 4. Check for traps. Is this a real breakout, or is it a liquidity sweep? Wait for the candle to close. Check the volume. Step 5. If and only if all 4 steps check out, then you move to the next step, finding your entry zone. And that's exactly what the next video will cover. Most traders learn entry techniques before they learn to read the market. They apply the right technique in the wrong context, and they wonder why they keep losing. Remember what I said at the beginning. Market structure is the foundation. Every strategy, every indicator, every entry signal, they all sit on top of this. And now you actually understand what's underneath. You can read the market, not guess, not hope, read. So here's what I want you to do right now. Open any chart you're watching. Run through the 5 steps. What does the higher time frame say? What state is the market in? Who's in control? Are there any traps? Drop your analysis in the comments. I'll review them, and make sure you're subscribed because the next video is where we build on everything you learned today. How to identify the exact buy and sell zones and the specific